Hello, I've had a few comments requesting a video about the schedule of non-current assets. We know that limited company accounts are coming up in sections B and C. So this is a potential section B question, although we haven't had anything on cash flows in the first 3 years of this exam. So I'm thinking potentially maybe there's more chance of that, but just in case, this will do no harm whatsoever to go through because it does focus obviously on depreciation. As well as putting the schedule together. So let's have a look. This one came from the June 2020 paper one, so there'll be a link to that in the notes accompanying this video. So we've got a chain of fast food shops, and they've given us an extract from their statement of financial position at the 31st of March 2019. So we've got three categories of non-current assets. We've got land and buildings, we've got plant and machinery, and we've got fixtures and fittings. And they've given us the cost brought forward for each of those and the provision for depreciation. So remember, the provision is the accumulated depreciation that's been provided to date on all of those assets, and then the net book value, which is obviously the cost minus the provision. So that's the situation taken straight from last year's statement of financial position. And if we just have a look over the page, what they're asking us to do is complete a schedule of non-current assets for the year ended 31st of March 2020. A total column is not required. So in real life, you would probably have a total column going down there, but we're not required to do that. So they've been quite kind here. They've given us the layout. In past exams, we've seen just a blank page, not even any columns. So this wasn't too awful in that respect. And they've actually been super kind and given us the opening balances. So they've actually transferred the figures straight from the schedule from last year. So these figures have been put in. So we've got the opening balance for the cost, we've got the opening balance for the provision for depreciation, and then last year's, I'll just slide that up a little bit, let's make some room, last year's net book value for comparative figures. So what we've got to do then is explain what's happened in non-current assets during that year. Okay, so let's have a look at the information that we've got available to us. So it says that during the year to 31st of March 2020, the following changes occurred. So land that was valued at 200,000 was included in the land and buildings figure. Okay, so in there, we've got 200k of land, which means that the other 600k is going to be buildings. Let's just squash that in. Oops, I can't write this evening. 600,000 of buildings. Okay. So the land that was 200,000, that's not very good too, has been revalued. The rest of its buildings, land is to be revalued to 500,000. So at the moment, it's 200,000. So minus 200,000 from there is a £300,000 increase. Okay. Now, if we look at the land and buildings here, we can see that the land and buildings is 800,000. Depreciation was only 72,000. So what we need to do is find out whether any of that depreciation was to do with the land or whether it was all on the buildings. So it actually tells us down here that land is not depreciated. So when it comes to revaluing the land, it's 200,000 at the moment. It's going up to 500,000. So we've got an increase of 300,000. So we can put a revaluation straight in there, £300,000 to land and buildings. So they're now 1.1 million, and we haven't done anything with the depreciation. So what we need to find out then, so the plant and machinery were disposed of. They'd originally cost £16,000 and were sold for £10,000, which meant a loss on disposal of 240 was recorded. Now, if we've got a disposal of non-current assets, we need to get rid of the cost out of here. So we're going to remove, out of this column, the cost of the assets. Now, if you look here, we were told that they'd originally cost £16,000. So we need to remove those from the plant and machinery column like that. We also need to work out how much depreciation, because one of the lines we have down here is eliminated on disposal. So we need to get rid of any depreciation that's to do with this 16,000. So let's just have a look and see if it tells us how much the depreciation was. So they cost 16,000 and they were sold for 10,000, which means a loss on disposal of 240 was recorded. Now we've got three pieces of information we need. We need the cost, which was 16,000. Let's move that across a bit so you can see it. So the cost was 16,000 minus the depreciation, which at the moment we don't know. equals the net book value. Now, at the moment, we also don't know the net book value. It hasn't told us. But if they were sold for 10,000 and we had a loss of 240, that means that they've been sold for £240 less than the net book value. So we can say that therefore the net book value is the £10,000 that we've received, £10,000 sale proceeds plus the £240 loss. So the net book value is 10,240. So depreciation has to account for the difference there. So that's going to be, what does that work out? 5,760. Okay, so just to recap with that one then, we've got the cost that was given to us. We didn't know the depreciation and we didn't know the net book value. If we knew the net book value, it's just a simple case of one minus the other, but we can work out the net book value because we had sale proceeds of £10,000 and we made a loss. So if you've made a loss, it's because you've sold the assets for less than their net book value. So you need to add the loss back on to the proceeds to get your net book value. And then depreciation is a simple case of the balancing figure. So let's pop the 5760 in here. Eliminated on disposal. It was plant and machinery. Always make sure that you get it in the right column. It's very easy to put something into the wrong column. Okay, so that's number 2 dealt with. Number 3, it says fixtures and fittings were purchased at a cost of £12,000. Okay, so that's a straightforward addition. It's going to go on to tell us something about part exchange here. But let's pop the additions in here. Normally you'd put the additions in before the disposal, but I'm a big fan of just dealing with things as they come along. So don't worry too much about what order they go in here. So we're adding, nearly did the wrong column there, £12,000 into the fixtures and fittings column. Okay, so that's the new assets that have been bought. Some old fixtures and fittings were used in part exchange at a value of £3,000. So that was the sale proceeds. That meant that a profit of 376 was recorded. Now, if we make a profit, it's because we've sold the assets for more than the net book value. So if we were part exchanging them for £3,000, that's the sale proceeds. So the net book value is going to be £3,000, this time minus £376 profit, which means that the sale proceeds are, whatever that works out to be, 3,000 minus the 2,624, isn't it? 2,624. Okay, so that's going to enable us to do this little calculation again. So we know that the cost was originally 4,100. We can put that straight in here. So we can take out the disposal, 4,100 there. So making sure that that's in that right column, the fixtures and fittings. The depreciation, we don't know at the moment, that's a mystery figure, but we do know the net book value now because we've just worked it out. It was 2,624. So that means that the depreciation is going to be the difference between 4,100 cost and the 2,624 net book value. So depreciation was 1,476. Now, that's on the disposal, so that again is going to be eliminated on disposal, 1,476. Okay. Right, so that's the additions and the disposals dealt with. There were no other additions or disposals to non-current assets. So the only other thing then that we need to do is the depreciation. Now it says here that land is not depreciated, but buildings are depreciated at 3% per annum. Now if you remember up here, the land was valued at 200,000 and that had been bumped up to 500,000. And then we worked out the difference. So from the brought forward figure, we had 800,000 in there, 200,000 of which was land, which leaves 600,000 of buildings. So 3% per annum straight line, so it's just based on the cost. So 600,000 times 3% is £18,000. So all we need to do is pop that in here. So depreciation charge is our next line here. And on the land and buildings, quite simply £18,000 going in there. Okay. Now, plant and machinery is depreciated at 20% using the reducing, it says line. Now, this is a bit of a typo, I think. That should say reducing balance. And just for once, this is the exam board's typo, not mine. So 20% reducing balance. There's no such thing as a reducing line depreciation. It's either straight line, which is based on cost, or it's reducing balance, which is based on the net book value. Okay, so what we need to do is see how much we're going to need to depreciate. So the starting point from this is going to be the 128,000 brought forward. So we had a 128k brought forward. Okay, it tells us down at note 4 that all non-current assets are charged a full year's depreciation in the year of acquisition, but none in the year of disposal. So if you remember, over on our schedule of non-current assets, we have got a disposal. We haven't got any additions here though. Now, because it's reducing balance, we need to know the net book value of the disposal. And because we did such lovely neat workings up here, we can see that the net book value was 10,240. Okay, so the depreciation is going to be based on 128,000 brought forward minus the 10,240, which is the net book value of your disposal. So if we do one away from the other, we get 117760. We're doing 20% reducing balance depreciation, which is 23,552. Okay, and that's going to go in here, plant and machinery, 23,552 depreciation charge. Okay, we're nearly there. Fixtures and fittings are straight line this time, 20% per annum. So it's all based on the cost. So for the fixtures and fittings, we're interested in what cost we had brought forward. We're going to need to add any additions, any new assets that have been bought, and deduct any disposals. So we're going to start with the brought forward, which was 85,900 brought forward. We're going to take off the cost of that disposal, so that £4,100 here in the fixtures and fittings column, so minus 4,100 disposal. And this time it is the cost, not the net book value, because remember we're doing straight line depreciation. And then we need to add on the cost of the addition, so £12,000 for the additions. So if we put all of those in together, sorry, I didn't move the paper up fast enough, we are depreciating a total of 93,800 at 20% per annum, which is going to be, what does that work out? 18,760, I think. So we can pop that figure straight into there, 18,760. Okay, so just check that we've actually worked through everything. We've ticked them all off. We did the depreciation on the land. We've dealt with depreciation on the plant and machinery. We dealt with the fixtures and fittings. And actually, before we could do that, we had to read note 4. So always just glance down and find out what your accounting policy is. Obviously, it's a heart sink moment if you get reducing balance and time apportioned. Straight line and time apportioned isn't so bad, but remember that if we've got that situation, your depreciation charge for the year is going to comprise 3 things. You'll have to calculate depreciation separately whenever anything is time apportioned on assets that were there for the entire year, so the brought forward minus any disposed of assets. Then you'll have to work out the depreciation on the disposals just up until the date of the disposal, and then you'll have to work out the depreciation on any additions starting from the date that they were acquired. Okay, so that's the mess that we get into when it's time apportioned. Depreciation calculations are often made up of 3 things. So nothing to worry about here, but if you see other questions, then just bear that in mind. Okay, so the last thing we need to do then on our statement of non-current assets is actually calculate the balances at the 31st of March 2020. So I'm going to draw, I can't find my ruler, so I'll just draw some slightly wobbly lines there. So we're going to add up the land and buildings. We've actually got 1,100,000 in there. Plant and machinery, 250,000 at the start, minus 16,000 leaves us with 234,000. And then with the fixtures and fittings, we had 85,900. We added 12,000. We took off 4,100. So we're now left with 93,800 in that column. And then we can do exactly the same with depreciation. So at the 31st of March 2020, draw some total lines. Sorry about the wavy lines here. So we can add 72 plus 18, 90,000 in there. We had 122,000 on plant and machinery. We eliminated on the disposal 5760, and then we worked out the charge for the year was 23,552. 52. So we add and subtract those. We get 139792. And then lastly, we can do fixtures and fittings, starting with the 30924 minus the 1476 plus 18760 gives us 48208. And then the very last thing to do down here is the net book value. So for each of these, we're going to take the cost and then we're going to take off the depreciation to date, and that will give us the net book value. So for land and buildings, 1.1 million minus 90,000 is 1010123. And then we've got 234 minus 139792 leaves us with 94,208. And then 93,800 minus 48,208 leaves us with 45,592. Okay, so that's what your schedule of non-current assets, if I can squeeze it all in there, is going to look like by the end. Apologies, it's slightly out of focus in the corners. You might be asked about limitations to these schedules. So obviously it does give the users of the financial statements more information than would be on the statement of financial position. The statement of financial position would just have the total, these three net book value figures lumped in together. So this does give us a bit more detail about what the assets are. It tells us that the land and buildings have been revalued, but it doesn't give us detail. It doesn't tell us whether it was land or buildings or both. It doesn't tell us about the specific types of assets. So what is this plant and machinery? What's been sold? It doesn't give us any reasons why. And it doesn't tell us the sale proceeds. Now, we obviously have got all that information in the question. We've been given that. But if you were just looking at the year-end financial statements, you wouldn't be able to see whether there'd been a profit or loss on disposal. That would be on the income statement. And you wouldn't know what the cash effect on these were. You'd have to look at the statement of cash flows. And again, that's only in summary form, so it wouldn't tell you about individual transactions. But it does give us more information than we would have if we didn't have a schedule of non-current assets. So just be aware of the limitations of it. Now we had an extra bit on this one, 14.2, a little 6 marker. So if you remember, the 20 mark questions in section B have 14 marks of computational work to do first, and then it's followed by a little 6 mark written question. And again, you're having to get up this ladder up to the dizzy heights of level 3 for the maximum 6 marks, which means you do need to know your stuff. So it tells us that in May 2020, Kubica PLC had its buildings professionally revalued and has been advised that the buildings are worth double their original cost. Assess the implications of revaluing the buildings based on the new valuation. Well, if you remember that last year, it was the land that went up in value. So we had an increase. Let's just put that back on so you can see what happened here. The revaluation, if you think about the double entry for this, we've debited land and buildings with 300,000 and we've credited a revaluation reserve with 300,000. So that increases the value of the business, the net assets increase, and also the equity of the business. So the shareholders' funds are also going up by £300,000. So that's good for them. The business might be accused of window dressing though. If we were to bump up the value of the buildings, so remember that the buildings were 600,000 of this, we'd be eliminating the depreciation, so we'd have to get rid of that, and then we would increase the value, so we would double it, we'd include another 600,000. So that would actually give us a lot more in our revaluation reserve, so the shareholders might be pleased with that. But just remember that the revaluation reserve can't actually be used for anything, can't be used for paying dividends. All we can do with it is convert it into bonus shares. So it's probably of limited value really to a shareholder. So the fact that the value's increased, it would help to reduce things like the gearing ratio, because anything that helps our equity go up in value will reduce the gearing value. We can maybe use the assets as security, so it's reflecting the fact that they're worth more. The company's going to have a higher asset value, so that might look more appealing to potential investors, potential lenders, that kind of thing. Obviously, the depreciation is going to go up. We've got at the moment £18,000 of depreciation. If we double the value of the buildings and carry on depreciating, that's going to go up to 36,000. So that will actually reduce the profits. Remember that revaluing an asset doesn't increase profits, it just increases the equity, whereas the depreciation charge will have an impact on profit. But I think overall, we can point out that it will make the accounts look better, but we need to be aware of the fact that there's no cash gain. It's an unrealised profit we're not going to get any money from it until we come to actually sell the land and buildings. So it will make the accounts look better. It will increase the value of assets and equity. So I think overall the shareholders would probably be quite pleased with that. Anyway, hopefully that's given you an idea of how to put a schedule of non-current assets together, and a little bit of a refresher on dealing with disposals, dealing with depreciation, and finding missing figures. So if you've enjoyed the video, please like and subscribe to my channel so that I can keep you up to date with any new material that I issue. Thanks for watching.